Welcome to the Kansas Commodity Outlook and Tailgate Party. Today we thought we'd do a bit of an outlook. I've recruited Dr. Allen Featherstone to come in and speak to us for about 20 minutes on the macro issues, and then Dan O'Brien and myself will be speaking to more of the markets. And I've asked Eric Atkinson to come and moderate the session for us. So Eric, I'll turn it over to you. You'll perform here as master of ceremonies, etc. So,
thank you, Guy, and thanks for joining us. What we are going to do here is pass along some information. I say we, these gentlemen here, regarding the grain market outlook, the economic factors domestically and internationally that are working in the direction that are driving these markets. And we'll have a look at the macroeconomy as well, give us some broad perspective on a lot of things that you folks are interested in, inflation, et cetera, which all ties in, of course, to the markets. And then afterward, there will be tailgate fare, I'm understanding, as part of the Commodity Tailgate, and we'd like to thank the commodity commissions for wheat, for corn, for grain, sorghum, and soybeans for sponsoring this overall event this afternoon. And we have a perfect Saturday for college football to boot, so it's all good. First, I want to bring Allen Featherstone up. Allen is the head of the Department of Agricultural Economics here at K-State. Allen's been here a long while and is very astute in the area of the general economy and all things economics, quite frankly. He's put together some thoughts on the macroeconomy to share with you. Those of you who are watching via Zoom and participating, we would note that if you have questions as well during our Q&A, after Allen's presentation, you can fire those away via the chat, and we will share those with Allen for a response as well. And obviously, those of you here in the auditorium are going to be invited to ask any questions of Allen or Guy and Dan as they speak as well. So, Allen, if you take it away, please.
What we're going to spend a little bit of time is looking at the macroeconomic picture and then the farm economic update. You pretty much can't turn on any of the media without hearing that inflation is up in terms of we've seen the September year over year has increased 5.4%. And if you go back and look at that, that's roughly the largest increase in 30 years for the consumer price index. Certainly, people have an interest in terms of where is the macroeconomic economy going forward. One of the things that we'll spend a little bit of time talking about is looking at inflation and treasury rates, treasury inflation index securities, and then the farm credit cost of money rates, and then we'll conclude a little bit with regards to where we are from a farm economy perspective. In terms of the University of Michigan ends up doing a monthly price expectations, and they've been doing this all the way back to January of 1978. And so in terms of looking at this, certainly you can see the red line and the purple line. The red line is kind of looking at just the mean expectations, and then we also have the median expectations. In terms of looking at this, one of the things you'll see is that the mean is always quite a bit higher than the median. In terms of if you look at the mean, the last information that the University of Michigan has published indicates that essentially the mean expectation for price increases by the public over the next year is 6.1%. If you look at the median, it's a little bit lower. And so certainly there are some individuals that are skewed to the high that creates that mean to be quite a bit bigger than the median. And so looking at this, essentially, we've seen a big change in the University of Michigan expectations. In terms of essentially it's increased 2.1% from 2.5% to 4.6% from December 2020 to August 2021. And so 8-month period, essentially we've seen an increase of 2% in the expectations. The mean has increased quite a bit more in terms of essentially we've seen that increase by 3.1% over that same expectation. And so there are some individuals out there that have a pretty high expectation of what inflation is going to do over this next year's period. In terms of looking at this, the median, the highest was in January 1980, same type the mean was. And so in 1980, just to give you kind of where we are, the median was 10.4%, and so it was more than double in terms of what the expectations are currently. And then the mean was 13.8%. And so, again, you can see that certainly those expectations can be quite high. In terms of, I also looked a little bit in terms of how we've seen an expectation above 4% from a median. The last time that was over 10 years ago, in May of 2001, essentially was the last time that we saw expectations that high. And then the mean, the last time it was over 6% was July of 2008. And so certainly you're looking at high levels of expectations, at least from the University of Michigan survey, of about something we haven't seen in 10 to 13 years. One of the things is, why does this matter? And essentially, the important thing to realize is that eventually inflation is going to affect interest rates. And we haven't seen that as of yet, and I will show you this in terms of everything is so far being affected on the inflation-adjusted interest rate or the real interest rate. That has continued to fall as essentially interest rates inflation rates have increased. In terms of looking at this, the real interest rate, and we'll actually show you some numbers on this, is probably about 3 to 4% below what it normally is. And so normally, if you look at what the real interest rate is essentially the interest rate will be 2 to 3% above the inflation rate. And so that's the return that you're going to get after inflation. However, when we look at some slides here, it's very much negative. And so really one of the key things I think to look for is how long are investors going to accept a negative interest rate for lending. From a borrowing perspective, it's good in terms of essentially you're borrowing money at 5 and 10 years, essentially less than zero. And so you're paying a negative interest rate. And so certainly that does have an indication with regards to what's going on in the economy. But essentially, economists basically have this basic relationship between interest rates, inflation, and the real interest rate. And typically, and if you look at these across economies across the world, if you have economies that have high inflation rate, you will see high nominal interest rates in their economy. And so the key thing is, and we haven't seen this as of yet, and we'll show you some numbers on this, is when inflation increases, the market or nominal interest rate also will ultimately increase at some point in time. What I've done is basically looked at four interest rates, treasury rates, since essentially February of 2010 to give you a little bit of an indication of where we are. I have taken a look at the 1-year T-bill, the 5-year T-bond, the 10-year T-bond, and the 30-year T-bond to look at this. In terms of if you think about it, and if we look at what's happened since the pandemic, in terms of essentially those interest rates running up, then they ended up running down. When we hit the pandemic in February of 2026, there was a sharp decrease in all of the interest rates. Since then, we've had a divergence in rates. Essentially, the 1-year money has continued to go down. And so the short-term money, those interest rates have continued to fall since that decline. However, if you look at the 5-year, 10-year, and 30-year money, those have started to increase. And so if you look at where they were at the most or the lowest point after the pandemic began to close economies, essentially you can see that many of these have increased over 1%. In terms of the 30-year money, actually is down a little bit from where it was. In terms of, and also the 10-year money is down from where it was. The 5-year money is pretty level. But if you look at what's happened since August, essentially you begin to see a hook in terms of where the 5, 10, and 30-year money is starting to increase a little bit. And whether or not it goes up to where it was a few weeks ago is, I think, important to watch. But it is important really to consider the fact that there is a divergence between 1-year money and then anything with more length. The other thing I think it's important to realize is these rates are still historically low. In terms of 30-year money, 10-year money, 5-year money, 1-year money is extremely low. And so looking at this, and when we take a look at some of the expectations, you will see that. I've also looked at this more on a daily basis in terms of, and this is through Thursday, was the most recent information that is available. But I took a look essentially from March 2019 before that. Again, you can see the fall kind of in January, February, March as it became clear. We were moving into a pandemic situation. And in some respects, we're masking a little bit on the weekly. The 5-year money essentially jumped up in January of this year and has maintained flat. And we're beginning to see that increase as we move into October here. You see that the 5-year money is beginning to increase. The 10-year money actually jumped up quite a bit at the end of last year. And then essentially through the July situation, it began to get a little bit cheaper. And then after that, it leveled out. And again, we're seeing an increase in the interest rate. In terms of looking like this, essentially, certainly when the markets understood some of the impacts of the coronavirus, a huge decrease in all interest rates. In terms of, again, we have seen some increase in the 5 and 10-year bond rates since the fall. We haven't seen this in the 1-year money. And so essentially that 1-year money is as cheap as it has. And so you're getting a divergence between the longer-term money and the short-term money. Some of the T-bond rates in terms of the 5, 10, and 30 years are beginning to approach those pre-pandemic rates with regards to what's going on. In terms of using the Treasury indexed securities and the nominal amounts, you can actually back out what the market is expecting for inflation expectations. And so we can go back a ways here. And again, I have the same time frame, what I've looked at. But one of the things that's kind of interesting is the 5 and 10-year money are not really concerned about inflation. And so essentially what you can see is essentially if you look kind of what we've seen essentially from the beginning of the year, essentially the inflation expectations are, and actually let me switch here. This is actually not inflation. This is actually the Treasury inflected index bonds. And so essentially this is the return after inflation is subtracted out in terms of the rate that you're getting. And this is where you see some decreasing amounts in terms of on 10-year money, if you would invest in a TIPS, you're essentially investing at a negative 1.5% rate of return. And so essentially you're paying the borrower to essentially take your money. And so from a borrowing perspective, again, this is negative 1.5%. If you look at the 5-year money, you're down there at about negative 1%. And in some respects, you can see that this is quite a bit low in terms of when you had the pandemic. There was a blip where actually the cost of money after inflation increased quite a bit, simply because there was concern that inflation would drop, and some individuals even had a concern with regards to negative interest rates. You can see on a daily basis these Treasury-infected securities. They've been holding fairly steady there over the last year, over the last 14 months. And so essentially we've had this situation where essentially we're down earning a negative 1.5% and negative 1% on 5 and 10-year money. And so to look at this, the real interest rate summary, again, there was a spike when the pandemic hit. And we have seen a consistent decrease in the 5 and 10-year inflation-adjusted securities since then. And they are historically low, and they're basically at a negative real lending rate. And so historically, before 2008, those were in the 2 to 3% range, and now they're in the negative 1 to negative 1.5% range. And so the question is how long are investors going to take a negative return on treasuries after adjusting for inflation? Now we'll jump into inflation, and this is where we do see some movement, but in some respects you don't see as much movement here as you have in the Michigan survey. In terms of looking at this, kind of backing out that, you see that inflation, when the pandemic started, we dropped quite a bit in terms of the inflation expectations, going from that 1.5% to 2% range all the way down to about 0.25 to 0.75. After the pandemic, after that initial reaction, those inflation rates began to increase. We kind of leveled off there until kind of in January, February of this year, where we're back in that 1.5% to 2% range. Since then, however, we've seen these increase. In terms of looking at this, we've only seen these increase by about 1%. And so on 5-year money and on 10-year money, essentially we've seen an increase in that inflation rate from 1%. And if you think back from the consumer surveys on the 1-year money, essentially we're looking at 2, 2.5%, 3%, depending on whether or not you were looking at the median or the mode. And so in some respects, people have argued that this is a transitory type thing. The markets are kind of agreeing that this is transitory at this point in time because you haven't seen a huge run-up in those expectations. And so the thought is that this may be transitory. The other thing that's interesting is that normally the 10-year inflation rate expectation is higher than the 5-year. But if you look at kind of what's gone on, that's flipped. In terms of essentially the 5-year expectation of inflation is higher than the 10-year. And so again, the implications there are that the market is expecting a higher inflation rate in the short term than it is in the longer term. And so again, you do see a flip there with regards to where that is. We'll take a look at this on a daily rate, and you can see that essentially both the 5-year and 10-year money, those are both over 2.5%. And so as of Thursday, that's kind of what the inflation expectations are for 5 and 10-year money. In terms of on average, you're expecting a 2.5% interest rate over those periods of time. And so again, when you look at the Michigan information where consumers are really feeling it, essentially those that are trading these on Wall Street are saying, yeah, inflation is a little bit higher, but it's not anywhere near that 5% type rate. And so at this point, the market still assumes that this is a transitory type situation. And so looking at this, originally the real interest rates fell. And inflation expectations moved to close to zero. The big thing going on with regards to inflation is certainly there is a flip with regards to the expectations. The longer-term expectations of inflation are less now than the 5-year. And again, this is somewhat unusual. In terms of the last thing we'll talk about, and then we'll have 3 slides on the farm economy, is one of the things that I track is what is the cost that Farm Credit acquires their money at. And this is kind of a weekly indication here. And so essentially what this is the rate. And so 1-year money is pretty close to 0%. In terms of 10-year money, they're paying about 1% to Wall Street. 10-year money, they're paying about 1.5%. And if we look at 30-year money, they're paying 2.5%. And so if you look at this, essentially, these rates are fairly low in terms of what they acquire their money at. The issue is in terms of how much they mark that up as they turn that around to farm loans, but at least when they go to Wall Street to look at their money, you can see that they have followed the treasuries. And probably the way to look at this, or the way that I like looking at this, is essentially just subtract the Farm Credit acquisition rate from the T-bill rate of similar aspects, and you can get a little bit of an indication there in terms of how risky they think the agricultural sector is from a Wall Street perspective. You could argue that this is a lagging indicator as opposed to a leading indicator, but in terms of looking at this, essentially on 1-year money, on 5-year money, essentially they think that farmers have about the same risk as the government. And so essentially from that perspective, very low. In terms of even on 10-year money, you're paying less than 0.2% above treasuries. And so again, a lot of faith in the agricultural economy with regards to what investors are willing to lend to farmers. In terms of the 30-year rates, you've seen a little bit of an increase there over the last few weeks. But again, if you look at this from a historical perspective, essentially you're paying about a 0.6% premium above a 30-year treasury. And so again, if you look at this, those that are investing and providing funding to the farm credit system to be relent to agricultural producers and agricultural co-ops basically view the sector as being extremely safe. And in terms of looking at some of these numbers, essentially the acquisition for 30-year money is less than 3%. Again, extremely low from a historical perspective. In terms of looking at 5- and 10-year money, they're getting that between 1% and 2%. And 1-year money, basically, they're paying about 0.1%. And you can look at the spreads there, 0.05 or less for 1 to 5-year money. Essentially 0.2% for 10-year money, 0.7% for 30-year money. And so certainly from this perspective, from a borrowing perspective, the funds are extremely low from a borrowing on the farm credit. And so essentially you could argue that investors view lending to the U.S. government and U.S. farmers of equal risk over the next 10 years. And so I don't know if you want to have the same risk as the U.S. government, but in terms of at least investors end up having that similar risk. In terms of, we'll finish up with 3 slides on the agricultural economy. In terms of essentially the agricultural economy is good. In terms of 2020, essentially you saw a big increase in the Kansas Farm Management Association numbers. The actual net farm average income for the Kansas net farm, or for the Kansas farmers in the Kansas Farm Management Association was $166,000 per farm. And so certainly it's pretty much the high that you've seen in nominal dollars. The other thing that I track is I have a credit assessment model. And one of the things we see with credit assessment is we saw an improvement in terms of essentially the probability to default improved. And essentially the last 3 years have been pretty decent from a farm perspective in terms of turning that around. We saw a pretty big increase in that from 2013 forward. But again, the situation is positive. In terms of looking at just some 2019 and 2020 numbers, essentially net farm income popped up from 2019 of 114,000. It popped up to 166,000. In terms of the probability of default, dropped 0.2%, and that's a pretty big drop for an individual year. In terms of essentially that's a 10% move in that probability. And so that's a pretty high number. Debt to asset ratio, Kansas farmers continue to pay debt down. It went from 27.6% to 25.4%. In terms of working capital increased by 50,000. And so the liquidity as farmers went into this year was very good. And then repayment capacity, ideally you would have 100%. I would say probably about 60% of the years or 70% of the years, farmers do not generate enough income to pay principal and interest. Essentially, in 2020, anytime you get a number over 100%, that means that you have 17% more cash on hand to pay principal and interest. And so that's a good thing from a banker perspective. It's a good thing from a farmer perspective. It's a good thing from an economy perspective. And so where are we going forward? And this is my last slide, and then we'll have time for questions, I believe. In terms of looking at this, excellent financial shape, and it has improved. In terms of we've done some work that basically suggests that farm income in 2021 is going to be about 22% up from 2020. And so essentially, for example, that 166, we'll probably see a higher farm income there. What's interesting is most of that's going to be from the market, and very little is going to be from government program payments. And we went from about 100,000 in government payments in 2020 to virtually zero in 2021. And in terms of as an economist, that's one of the things I always worry about in terms of it's much more comfortable having income from the market as opposed to the government, simply because it's usually less susceptible to the vagaries of politicians. And so from that perspective, 2021, 2020 have been watershed years for the agricultural economy. In 2021, we're virtually going to expect to see very little government program payments. 2022, kind of going out, using futures prices in that. We're actually going to expect to see a little bit of a drop from the 2020 numbers in terms of essentially, if you take the 166 and knock off 20, that would be roughly 32,000 off the top, and so that would get you kind of in that 120 to 130,000. Obviously, there's a lot that can happen in 2022 that will make these estimates wrong. But in that perspective, if we look at the markets out 2 years, or out for the 2022 harvest, assuming normal yields and all of that is heroic assumptions in Kansas. We increase the input prices some, but essentially 2022 likely won't be as good as 2021, but it'll be better than 2020. But it will be in a fairly reasonable shape in terms of most times if you would tell farmers that they can expect a net farm income over $130,000 going into a year, that's a good year from a producer perspective. So with that, questions? Anybody with any questions for Allen? Go ahead. I know I've shoved a lot of information at you in a short period of time. But it is kind of interesting in terms of there's more concern about interest rates or inflation rates in the short term than there is in the longer term. The market has not bid in these 5% and 6% inflation rates. The other thing I think that will be key to watch is how long the market is going to accept a negative return for investing in T-bills. In terms of, and essentially if you look at this from farm credit money, they're also getting a negative return on what they invest in farm credit returns. And I think in some respects, there's safety there, so they like the fact that there's safety. And certainly if you think interest rates or inflation rates are going to increase, that's going to affect the stock market, and you would see a decrease in that. It would certainly dampen the thing, but from an agricultural perspective, kind of where the market is at this point. Investing in paying some of these land prices is not out of the ordinary. Dan?
So they're, in the long term, they're trusting market forces to force inflation back down?
That's the thought in terms of they're viewing this as being pretty transitory when essentially consumers are thinking it's going to be in that 4, 5, 6% range over the next year.
Security came in at 5.6 or 5.9, wherever it was.
Yeah, in terms of Social Security was high. But again, what they're looking at is, yes, there will be a high amount, but at this point,
they're going to force that down. That might be recessionary or whatever it might be.
It could be recessionary. It could be that the supply chains come unlocked. It could be maybe that things happen with fuel prices. But again, those are heroic assumptions in terms of you're making those 5 years, 10 years into the future. And my crystal ball is not that good.
Alan, when you're doing the inflation comparison, are you using a core inflation rate, which excludes food and fuel, or are you?
Essentially, with the markets trading the Treasury inflation index securities and essentially the nominal rate securities, essentially they can move those closer or further apart depending on what those inflation expectations are, and using kind of that fundamental equations with regards to inflation, real interest rates, and nominal interest rates. Essentially, you can actually look at what the expectations are in terms of inflation going forward. And so it would be an overall inflation rate. Certainly they're going to be concerned about everything in addition to the core.
One back there, go ahead.
Yes?
Your probability of stagflation?
In terms of, certainly, I think there is some probability that will occur in terms of there's a lot of concern with regards to what's going on. My son works for a company that manufactures booms, and essentially they're basically allowing people not to come into work for no pay. They don't have the steel, they don't have the parts in terms of they have a hydraulic part that essentially they got a order of 160, and that's nowhere near what they ended up ordering. And so essentially what that means is they can do 160 of those rigs. And before we ended up in this situation is they basically had orders out for 2 years. And so essentially if you ordered a product for them, the wait time was going to be 2 years. And so you can imagine that 160 of those little valves that they need for each one of the units is going to be problematic. And so with that, in terms of whether or not that's going to be unemployment or not, essentially those individuals are underemployed. It may be good in terms of at 70-degree weather in a fall that you don't have to go to work in terms of you can do what you want to do, but come January when it's below freezing, essentially that's going to hit hard with regards to the fact that you're not going to have income in. And so I do think there is some real aspects there that are beginning to filter through. And again, from a machinery perspective, a lot of what they're doing or using is the same type of parts that you're going to need from a machinery perspective. And so it may be the situation where it's more difficult to replace machinery or upgrade that. And so that's certainly something that I would pay attention to and probably think about that early as opposed to late. It may not be the same situation where you take something in for repairs or trade in right before harvest. You may need to do that a little bit quicker than typically you do. But on the hard goods, there's a lot of issues there with that. One of the things that I was going to pull up, and I will take a look at this, is essentially what's going on in the Hong Kong stock market in terms of essentially there's a lot of concern with regards to the softening of that market. And if that occurs, and I'm sure Guy will talk a little bit about that, could create all kinds of havoc with regards to demand for agricultural goods, and then also the ability to buy product from China, which a lot of our manufacturing comes from that part of the world. And so there is a risk there. The risk is certainly non-zero, and I don't know how high I would put on it, but I wanted to talk about that a year ago if I was given that talk, and so now stagflation is. And for those of you that aren't familiar with stagflation, basically it's when you have high inflation and high unemployment.
Okay. Back there. Last one.
Yeah, I'll ask a kind of question, Alan. When does the current labor kind of situation and retirement of the baby boomers really start to convert?
I think we're starting to see some of that already in terms of if you talk to a lot of individuals, one of their big issues is labor. In terms of I'm actually in the process of hiring a couple staff positions that are more clerical, and I guess I'll have a real test of that after the 28th to see what type of capabilities and applications we get for those types of positions. But talking to the University Human Capital Services that deals with that, they are indicating it's pretty difficult to find individuals that are willing to take those positions that are kind of entry positions at relatively low pay. And so it's difficult to find individuals that are willing to work for $30,000, $35,000, $40,000 in this plus benefits. And so I think the university's seeing it, and I think people across the country, especially in manufacturing and that, are seeing that also. And so it'll really be interesting to see in terms of how that affects in terms of the college grads that usually have higher rates in terms of will they be pushed down into some of those jobs that typically they're not hired for, in terms of if you're not producing as much stuff, you don't need as many engineers designing stuff. And so to me, for example, I think you're going to see some shocks in the labor market, and just try to figure things out with regards to where that is.
Very good. We're going to move on. If you have more questions for Alan, you can hit him up after the session here. But thank Alan for being with us, if you would, please. Appreciate your comments, Alan. What we're going to do next then is get right into the outlook scenario for the grain markets, and from an international as well as a domestic perspective. And Guy Allen is going to take care of the international front for us. He is the senior economist here with the IGP Institute at K-State. He's been here for a couple of years and has done some really great things in terms of analysis and insight on our international grain trades. When he shares his comments, then we'll have Dan O'Brien share his on the domestic grain market scene, and then we will open it up for questions. So we'll hand it to Guy.
Thank you, Eric. And thank you for your attendance today and interest in the grain markets. It's very interesting times. Dan and I frequently have had discussions, particularly over the last 6 to 8 months. I think we've both been in the industry 30 years or more, and I've never seen so many dynamic and moving parts as what we sort of see at the moment. I sort of want to run through quickly and touch base on sort of where I see the hot spots and the major situations internationally. And one thing that's sort of real key at the moment is the geopolitical situations that are really driving, or I guess put some undue risk out there in the marketplace. The one I'd sort of highlight is increasing tensions with in the South China Sea situation, and as that continues to develop, any of you that study geopolitics should be familiar with the Thucydides trap, and that continues to be debated as the relationships between the U.S. and China on a number of fronts, as well as China and the whole Asia-Pacific area have significantly increased the tensions in those markets, and it's impacting trade relationships not only with the U.S., but a number of trading partners in that market there as well. Also, reemergence of Russia as a major power as they continue to jockey for position in Eastern Europe and the Middle East, as well as their relationship with China. Also, one thing we're seeing directly that impacts international trade is increased government policies that restrict trade, protect markets, and particularly help secure their domestic food prices and food security. Just looking on the supply and demand front, they're a bit looking at the bit more fundamental situation. Currently, we've got prices while soybeans, corn, and wheat have all come down. We're seeing record high prices in palm oil, historically the highest they've ever been. Oats have also made historical highs, trading above $6.80 a bushel. Cotton's back up at 10-year highs. We're seeing energy prices make a significant rally over the last 8 months. They're back above $80 a barrel, and that's impacting ethanol and other energy prices there as well. The fundamentals that continue to drive that, we're seeing a tightness in corn and feed grains, historically tight, not only in the U.S. but internationally. Wheat has tightened its ending stocks projections up to a point now where wheat cannot be priced into the feed ration anymore, and that's increasingly going to remove that safety net that we've had there. We're also looking at a cotton situation that's the tightest it's been in a number of years. Continuing, we're having African swine fever as well as other animal health issues continue to persist, and it's not going to go away, and it puts a big question mark over demand, particularly for those key importers of China and at emerging markets of Southeast Asia. Those increased costs in fossil fuels and as well as crude oil, coal, and natural gas are also at 8 to 10-year highs for those commodities as well. From a weather situation, we're going to look at the drought situation in Canada and the northern plains, which continue to persist as El Nino situation continues to be moderately forecast as we go through these winter months, and we'll see how that evolves as we get to the key planting areas here in the spring. And then we're also have a dry weather situation down in Argentina, which has basically shut down the Parana River, frustrating the logistics and the exports of both corn and soybeans out of that key port facility there. One thing I want to look at particularly is ocean freight. And this I want to drill down into specifically because it drives commodity prices. We've seen ocean freight. This is the Baltic Dry Freight Index that comes out of the London Exchange, and last week we saw it reach a 13-year high, trading at 5,650. It's come back a bit just in the last week below 5,000. But think back just 10 months ago, February, March, and April, that index was trading at 500. So we've seen a significant increase in that. What that's meant for dry bulk freight is we've seen more than a doubling of the cost of ocean freight to take U.S. grain to its key end users. Freight from U.S. Gulf to China, it was usually about $40 a metric ton. Today it's over $80 a metric ton. And that reflects right back to the farm gate price for freight. Now what's driving that? There's a big demand for dry bulk freight, which isn't just grain. Breaking down your major commodities of iron ore and coal, iron ore makes up 30% of the world dry bulk trade, coal about 28%. Which add those together, it's over 60% of the demand for dry bulk vessels. Generally, these are the large Cape class, 120,000-ton vessels, but it does flow down through the Panamax-sized vessels, which are typically your grain-sized vessels, to your Handymax, which are about 35,000 tons as well. Now, just to paint the equation, total grain or agricultural goods makes up about 17%. That's the individual breakdown for the agricultural commodities. So the drivers, coal and iron ore, and your major destinations for coal and iron ore are Asia. China particularly takes in about 66 to 68% of your iron ore in the global trade. Australia provides about 51% of that, and Brazil is about 37% of that. Now, Australia and China are in the middle of a big trade dispute. They've quit buying Australia coal and quit buying Australia iron ore. So effectively, they've gone to Brazil. Looking at the trade distance on that, the biggest port in Australia to the biggest port in China is about 3,300 nautical miles. Switch that to Brazil, it's over 10,000 nautical miles. That's over a threefold increase in distance. Now, you've got a finite capacity in that supply chain with your bulk dry vessels. It takes them effectively 3 times as long to make that trip. So the supply of both iron ore and coal as well has reduced that, and it's, as a result, it's increased the freight rate and that cost of freight for dry bulk commodities. Now, the demand and the situation in coal and iron ore has reflected back in grain. Coal's sort of a similar situation. The situation has got so bad in China that they're basically shutting down their electricity generation capacity because they don't have enough coal coming in. And they've been shutting down their industrial complex, which effectively includes a good number of soybean crushing plants. And USDA is projecting China to import over 100 million metric tons of soybeans this coming year. If their crushing plants are shut down, they're not going to buy soybeans, whether it's from the U.S. or from Brazil on that. So we're seeing an extremely frustrating situation in that ocean freight, and that directly comes back to your farm price, cost of or value for your crops. With China last year being the biggest buyer not only of soybeans, which they are annually, but also the biggest buyer of corn, and increasingly so in wheat. So Dan, I'm going to turn it over to you for some comments more on the local situation.
Just briefly, for feed grains, in the broadest of overviews, we have a 15 billion bushel crop. It's not a 14. We haven't had a major crop failure, so we're not worried about supply, having adequate supplies at the moment. Positive so far for domestic use. Ethanol plants running pretty well because some of that's due to inflation on the fuel side, and corn prices coming lower into harvest. Generally a positive for that. So that's a positive for corn. There are other aspects of this, export prospects, et cetera, that we could talk about. Question on the inputs. We've seen fertilizer prices move to the higher side, and trying to do a calculation as to have we approached the point where we don't use fertilizer. Well, obviously we don't, because again we pay, I think, anhydrous ammonia 55 cents per pound of N here of late. 100 or 200 pounds of that per acre is an absolute necessity for what we're trying to produce. So we still have to use nitrogen fertilizers. Just on the margin, we'll be doing, I guess, every efficient practice we can to lessen that cost. Grain sorghum, some of the same issues that affect corn will affect grain sorghum on the cost of production. It may not be so much the cost effectiveness, but can we get it? It's a supply chain issue, whether we can get some of these key inputs. And it's more than fertilizer. I hear a lot of talk in western Kansas about key herbicides being unavailable. The big issue with grain sorghum, I think, will be that generally we still have positive export prospects, but a lot of that's dependent on China. China was the buyer of about at least 97, 98% of soybeans, of grain sorghum last year in the United States. For oilseeds, we have a ditto for soybeans as for corn. We have a sizable crop. In fact, I think that, and I have an error there. That should be a 4.45 instead of a 2.45. So my mistake on that is we have that graph there. 4.45 billion bushel crop. The change that's happening that could influence input costs for feed grains could push more acres to soybeans next year. And some of the same issues we're reading in South America as here with regard to availability of key inputs. So we're coming into the time frame when we're right now in South America, they're beginning their planting season for soybeans, first crop corn. So those are all issues. There's a La Nina afoot, and that generally brings some dry weather down there. So we have a lot of balls in the air, a lot of hand grenades that could come down and affect things. It'd be a interesting year if we had any crop problems in the southern hemisphere. And as you mentioned, Guy, cotton, strong world markets. The USDA came out, raised the projected price for cotton in the United States, marketing year average up to 90 cents. Last 2 years prior, we were at basically 60. So you see that in play. Again, we have a lot of cotton that's coming into parts of southern Kansas, very input intensive. A lot of herbicides, a lot of growth regulators, a lot of cost involved there. And so I'm not, it's not that we don't have great prices, but you wonder on the supply chain issues for these very specified herbicide and growth regulator products, are we going to be able to get them? That's my question. And for wheat, of course, tight U.S. and world ending stocks, tight world minus China ending stocks. Generally, the rains we've been getting of late, pretty positive for hard red winter wheat, growing prospects. As you mentioned earlier, Guy, we don't know whether Canada, the Pacific Northwest, will recover from their drought. Will that linger? If it would, then we have a year where we grew a better crop for hard red winter wheat, and the price went up. So, and that has to do with problems elsewhere. So this time, we were the beneficiary. We hope that doesn't shift around. In the interest of time here, I think we're getting pretty close. I wanted to at least show you the futures. So we're looking at Dees corn at 525, and again, trading over the weekend, it's even higher than that. This was Friday's close, November, 12.17 3/4 for soybeans. Dees hard red winter wheat futures, 7.43. Generally coming out of that last USDA report, pretty positive. The most positive commodity that came out of that was wheat. So to me, I pay attention to, yes, the current spot markets, and we're in the middle of harvest, coming into it for the feed grains and oilseeds, but then to look at the 525 Ds 21 and the 523 Ds 22, there's a lot of things that have to happen for that. And the input costs are going up, so our cost of production are eating into the profitability of that Ds 22 thing. So something to look at. Last thing I'll show is to look at some of the forward contract prices out in the country. Try to follow Colby, Salina, Topeka, Garden City, Hutchinson, and Columbus to try to cover the state. It's just really interesting to me to see for corn. In essence, we're looking at just about right around plus or minus a few cents, $5 as a forward contract price for next year, and we haven't got done harvesting this crop. For grain sorghum, 473, etc. That forward contract price for sorghum has declined relative to where it had been. So probably some worries about exports. Soybean forward contract prices uniformly in the 11s. And I think, and again, these issues of worries about feed grains getting their inputs and shifting of acres to soybeans, probably what's in play there. And then for wheat, and this would be a July harvest, cash prices now are, again, 708, 693 in southeast Kansas, 706, 7s, etc. How many times in your lifetime do you sit here in fall of a year and look to the next marketing year, see a 7 in front of forward contract prices? But how bold are we to forward contract those prices, given how risky wheat is to grow? One good thing this year that's unique is we have a very good crop insurance price, I think 708. So if anything, people might buy up their crop insurance. They have the chance to do that to insure their revenues. Eric?
We have time. Watch out there. We have time. For a few questions, just a handful of questions before we need to let you guys go and move on to things. So anybody with any questions for either Guy or Dan? Yes, please.
I think you kind of touched on it for either of you, but how do you expect the farmers to maybe shift their acreage, or kind of what do you think of the cost?
That's a good question. I was asking Dan that last week and this week, and looking at that gross margin analysis, because the competition we're going to see for planted acres, similar to last year, but probably more so this year, between not only corn and beans, but wheat's definitely in the mix, cotton now increasingly so, which wasn't in there last year, grain, sorghum as well. It's going to be quite dynamic, and I think as we approach spring, you're going to see the price relationships move around quite a bit, depending on how those balance sheets tighten up and what the future forecasts are for ending stocks. And I think right now the market's feeling increasingly comfortable, but I would take a bit of exception with that. The exception is the big wild card in all those commodities, corn, soybeans, cotton, and wheat, is China. And that's the one that keeps me awake at night for a number of reasons.
There's preliminary analysis out there, say 3 million less acres of corn just because of input problems. And if that 3 million acres of less, and that means where's it going? Well, it's probably going to soybeans. So that's that $11 issue forward pricing.
Just on that point, does wheat have a chance of stealing corn acreage?
Well, I guess for October it still could some. And we're seeding hard red winter wheat right now.
Even spring wheat.
I wondered coming into this, with the high prices we've seen for hard red winter wheat and generally lower input needs, if maybe that would pull some acres of hard red winter wheat away from other commodities. But we're almost out the backside of that window. It'd be the spring wheat folks that'll answer that next.
Anybody have any other questions real quick? Please, go ahead.
Guy, do you think soy oil has hit its high?
No. And that whole soy oil complex is being driven by palm oil, and they continue to have what's really driving that is government policy in the biofuels situation, and I don't see that government policy changing, not only in the U.S. but in Europe particularly.
Renewable diesel is really coming, and we're building plants in our state and elsewhere to hit that market.
And
How high can it go?
well, it's higher than I thought it would go already. But it's way up there. But the interesting thing, coming back to the planning question, is oil goes up and meals goes down. You can store oil, you can't store a meal. You've got to clear it. But it's definitely showing an advantage for your higher oil seeds, like number one, canola particularly, and even soybeans and your other oil seed type crops. And I was asking Dan the other day, is that going to change the planting intentions for those higher oil seeds? Canola particularly being the one of most interest.
I remember when ethanol was being those plants were coming in, and there was a very inelastic demand for it, driven by renewable fuel standard. They could pay anything they wanted to, and nobody else could compete with them. I don't know that we've got that type of an inelastic demand pull, that you can barely meet with renewable diesel. I think it's more of a steady growth thing. It seems to be what we're seeing.
Well, without any further questions, the rest of your tailgate activities await. So please thank these gentlemen and again, Allen, for their time and expertise. And thank you for being here, and go Cats.